Hello, and welcome to The Insight by Oaktree Capital. I'm Nicole Adrien, and today I'll be having conversations with three Oaktree thought leaders, including co-CEO Bob O'Leary. We'll discuss topics from Oaktree's recently published quarterly letter Roundup. We'll talk about where we are in the credit cycle, whether issuers are delaying their day of reckoning, how liability management exercises have come to dominate the picture, and how investors might use demographic trends to find refuge in pockets of the real estate market. My first guest is Bob O'Leary, Oaktree's co-CEO. Bob, it's great to have you.
Great to be here. Thanks for having me, Nicole.
Bob, in this edition of the Roundup, you touch upon the unprecedented buildup of low-rated debt following the global financial crisis. In fact, you mentioned that outstanding high-yield bond, leveraged loan, private credit, and BBB-rated debt has quadrupled between the end of the financial crisis and present day, and is currently over $13 trillion. So how did we get here?
Yeah, so we didn't select those four segments at random. Those are what I would identify as sort of our addressable market at Oaktree at large. And those four segments, yes, there's been staggering growth, most of which has been driven by a confluence of two major trends. You have had, at least between 2012 and 2020, unprecedented cheap money policies. And you've had two things come together. On one hand, you've had the rise of alternatives that promise higher yields and have been seeking ways to leverage their investments to make appropriate returns. And on the other hand, you have the rise of vehicles to provide that leverage, the largest example of which is CLOs. And the confluence of those two trends have made for an unprecedented buildup. That obviously got disrupted over the last several years, but between 2012 and 2020, it was just unabated growth in the debt markets, especially those four segments that we mentioned. And I would further note that growth was in excess of what we would consider the underlying growth of the economy, the global developed economies. When you see that, it makes us suspicious that there is going to be a blow-off of some form. Haven't seen it yet, but we can talk more about what we think may lead to that.
I'd love to get into that. Let's talk really quickly about the Fed tightening cycle, which has been pretty rapid and it's created a distinction among borrowers. Can you elaborate on that distinction? Tell us why it's relevant in the context of the credit cycle here broadly.
Sure. So let's just use those four segments we just talked about. The easiest distinction is between floating rate instruments and non-floating rate. And the floating rate are the leveraged loan market, and obviously most of private credit is floating rate as well. Most of these balance sheets are set up in a way where they have not hedged their interest rate exposure. That became manifestly evident over the last several years. And more to the point, they were capitalized in a way that, at least by historical standards, was very aggressive. So floating rate, unhedged, poor capitalization or aggressive capitalization to start with, those are the balance sheets that when the Fed tightening started in 2022, those got left out in the cold and saw the most severe shocks. High yield and BBB, obviously that's fixed rate. Those balance sheets tend to be a little more conservatively capitalized, so they were in better shape. But as we've now had 2 years of extended tightening, which only loosened of late, even those balance sheets have had to refinance their debt into more what I would describe as onerous instruments, especially from the standpoint of the cost of capital that they have to provide to get people to refinance their debt. You combine that very swift tightening cycle with the unprecedented buildup in debt that we just talked about, and you've got a lot of balance sheets that are simply stretched. One way to think about it, you take the average loan, and more often than not, it was a sponsored loan, and again, capitalized or set up with leverage that would be aggressive by historical standards. That increase in rates, we think of that in terms of what it might have done, what an equivalent move on the operating side of the business would have been. That 500 basis point move was equivalent to a reduction in EBITDA of 25 to 30%, which is obviously quite severe.
That's really interesting. So, Bob, we're going to circle back to the blow-off point that you made earlier. So at Oaktree, we often talk about how strong economic conditions, the loosening of credit standards, and increased investor willingness to bear risk can precipitate distress. These conditions have all really been rather evident, but it's not clear what might set off the next major leg of the credit cycle. So what do you think about that? What do you think could create that blow-off that you mentioned earlier?
Yeah, the easy answer to that is a recession, but we're not in the business of predicting recessions. I would say that I'm not quite as sanguine as the rest of the market on some of the underlying economic statistics, but again, we're not really in that business. But what I think we do see real time, you've had the macro stress that we just talked about, the tightening of the rate cycle, which has been quite dramatic. You've also had another macro stress introduced to the equation, which is the maturity wall. And then you step one layer below that, and there's a lot of stress at the industry level. We talk a lot about healthcare. Healthcare is a fascinating case study in what's going on right now. Coming out of the pandemic, you had winners and losers, but one thing that was very evident across all healthcare companies is that they were facing a lot of wage inflation because there was a lot of competition for talented healthcare professionals. That drove wages up. And the way the industry is set up, it does not adjust immediately, especially when you look at the setup of the major payers. So they're not adjusting for inflation. So that was one shock to a lot of the balance sheets in the healthcare sector. Now you have some other interesting trends developing. The one that I've watched and I think is quite interesting is the consolidation of the payers, which has given them a lot of strength, and they are exerting that market power to take economic value away from other parts of the healthcare value chain. So you have large insurance companies pressuring providers in a lot of cases to extract gains from them. And a lot of the companies in the provider sector were the subject of buyouts. So their balance sheets are in tough shape. They're paying a lot more for the employees they have. And then they're facing these additional stresses of their major customers demanding and extracting value from them. So we're seeing a lot in healthcare, and you could look at several other areas of the economy. Media is undergoing very significant secular transition. Telecom, the same thing. And you're seeing these sort of mini cycles develop in a lot of these industries that are giving rise to pockets of disruption. That's happening in the face of pretty good economic conditions. Economic conditions, again, that I'm not sure will persist. But you put all that together, and there's plenty to do. There's a lot in the market right now, much more than there was 4 or 5 years back. Now, if we do get an economic recession, these are companies that are not set up for a recession, and you'll see a lot of stress start to develop.
So, Bob, yes, we often say that no matter the general economic environment, there's always pockets of stress. And you've mentioned a confluence of factors leading to stress in certain industries. I want to come back really quickly to the unprecedented level of debt that we talked about at the top of the segment, and the fact that I've heard you talk about if there was just a slight tick up in the default rate, it would create mass opportunity. Can you talk a little bit more about that?
Sure. By our analysis, you would need defaults to go back to historical levels, which are 4%. We're in the low twos in respect of high yield debt. We're in the high twos with respect to leveraged loans. That's including what we call selective default, which we can talk about. But if those numbers were to advance up to and close to the 4% layer, given how much debt you're operating on that $13 trillion, that would be a tremendous amount of defaults to work through. In some ways, if you had that 4% running for a couple of years, say 3, even at that just historical average, you would cumulatively exceed what we saw during the financial crisis, which is the high water mark that we measure all default cycles by. So you're not talking about a major default cycle in percentage terms, but just in that sheer amount of debt.
Sheer volume. Well, let's take a little bit of a dive into the public versus private credit market. That private credit market has really evolved since the time of the crisis. How do you think the credit cycle could play out differently between those two, public credit and private credit?
Yeah, private credit is fascinating. So you look at the long-term sweep of the last 15 years, and what is private credit? Private credit is the result of the disintermediation of financings that the Fed determined they did not want the banks involved in anymore. And a lot of that was sponsor-related activity, because that's what got the banks in trouble back in 2007, 2008. And the big difference between having that sort of financing in the banking system as opposed to in a private credit vehicle is in the banking system, you had the regulator looking over the shoulder of the banks on a regular basis and saying, no, that's not appropriate. So the banks had to mind their P's and Q's. Private credit market does not have that dynamic. You've got a largely unregulated sector, and you could argue whether that's good or bad, but I think there are responsible actors in private credit, and I think they're doing the right thing. But the fact of the matter is there's really no one looking over their shoulder. There's no governing body to call balls and strikes with them. So it has allowed, I think, some latitude. More recently, if you look at some of the publicly available data, you see a lot more loans being converted into PIK and having their maturities amended. Those are not things that usually happen together. If you convert something to PIK, it means there's a problem in the underlying loan because it's not able to meet its cash interest obligations. So if that's the case, you wouldn't normally expect then that somebody would push out the maturity, but that's what's happening. So you're getting some latitude in the private credit sector that you would not have seen if these were loans that were held in the banking system. And I think what that means is you're going to push out any problems that you might have. Doesn't mean you're changing the economic reality of the underlying loan, but you're not recognizing that potential loss at this point. So is there a day of reckoning coming in private credit? Again, if we get an economic cycle, for sure, private credit will not be immune, and maybe it'll be even more severe because you'll get things that should have defaulted 2 years ago defaulting, but at least for the time being, it's fine. Public credit doesn't have the benefit of that situation. Most of them are rated, so the ratings agencies are keeping an eye on the health of these loans. They're traded, and they're closer to reflecting the economic reality of the underlying company or asset. When you look at how the default cycle is going to play out between the two of them, you're going to see it more pronounced, at least on an immediate basis in the public sphere. In the private sphere, again, you can do this amend process that delays the day of reckoning. So the public side, you're going to see a more immediate default cycle. There's a lot of ways to bridge over problems on the public side. The documents, we can talk about that as well, are set up in a way that allows them a lot of latitude to bridge themselves. But the problem that's going to have to be recognized on a more immediate basis. In the private sphere, you have one or maybe a few owners of an instrument, and they can all agree that they're just going to ignore the problem for the time being in the hopes that the company recovers. It's just a question of the timing. I think on the public side, it'll be recognized. On the private side, it may not be for a while, but they're all going to have to, at some point, figure out a way to manage these balance sheets, which are in many cases just overextended, and they don't reflect what a proper capitalization for the company would be.
Well, my next question may or may not connect to what you just said. It's been understood, I think, over the last year or so that many managers, particularly those in the private markets, have been hiring bankruptcy and restructuring experts really at full gallop. Why do you think that might be?
Yeah, I think it makes imminent sense for the private managers, especially when you realize in a broadly syndicated loan, it's held across a lot of different managers. And in those cases, you can pool your resources and hire a third-party restructuring advisor. And there's the ability to externalize the effort. When you're the only owner, as you often are on a private credit basis, you can't share with other lenders the drag or what's needed to work out a loan. So you're going to need that person in-house to manage that. I would say as many people have been hired on the private credit side, I'm not sure it's enough. Because if you get anything rising to even an average level of defaults, the level of resource required to work out a company does not vary necessarily on a linear basis to the size of the company. So working out $1 billion bankruptcy, a balance sheet of that size, is not necessarily 10 times the order of effort needed for a $100 million balance sheet. In fact, it varies probably only by a factor of 2 or 3. So smaller companies do still require a lot of the same things that a larger company will require. And I would question whether private managers are properly set up to handle, again, what could be a very significant load of restructuring those smaller companies, especially when you factor in what I said first, which is they need to be the person solely working that company out. And when you do take that company over, it becomes a very time-consuming effort. You're responsible for figuring out the operations and everything else.
I think you'd say the surface is deceptively calm, most likely, and we're going to see some more pain here to come, and that's probably what's created that trend. Lastly, Bob, you're our credit sage. What advice do you have for credit investors today?
So it's, I think, consistent with what we've been saying since the start of the rate tightening cycle. When you consider the state of balance sheets, when you consider the laxity of the documents that govern those balance sheets, when you consider how aggressive and how comfortable sponsors are going to be with LME liability management exercises. You put all that together. If you're going to be invested in credit, especially sub-investment grade credit, you should make sure that you are sizable in a capital structure. So the sponsor or the party in interest has to deal with you. You should make sure that you are flexible and that you can, for example, take equity or equity-like instruments back. And you should make sure that you have capital to follow your investment. So if there's a new money requirement, and in a lot of these LME situations, there is a new money requirement, you can provide that. If you're not all three of those things, a lot of times you're going to be the one that has value extracted from them by the sponsor, by the rest of the capital stack. So those are the things I would pay attention to. And if you're not in a situation where your capital can address those three characteristics, I think you're going to be compromised in the next couple of years.
Bob, thanks so much for joining me.
No problem. Thank you, Nicole.
In my next conversation, we'll discuss the advent and now the onslaught of liability management exercises, or what are known as LMEs, as a tool used by issuers to postpone or avoid bankruptcy. We'll explore how LMEs work and how to be sure you're on the right side of this phenomenon. For this discussion, I'm joined by Steve Tesoriere, co-portfolio manager of Oaktree's Value Opportunities Strategy. Steve, it's great to have you on today.
Thanks for having me, Nicole.
Steve, your strategy focuses on opportunities in which Oaktree's deep expertise in restructurings and distress can offer an advantage. You've talked a lot recently about the opportunity created by issuers engaging in liability management exercises, what I referred to in the intro as LMEs. Let's start by first explaining what an LME is and how it originated.
So an LME is when a company with an over-leveraged balance sheet wants to address its debt. Usually that's because it has near-dated maturities. And these come in several forms. They could be stripping of assets of the company, negotiating with creditors for debt discounts, maturity extensions, and oftentimes these come with new money as well.
Great. So you've described in the Roundup LMEs being the legacy that's left behind by covenant-light loans. How are the documents in an LME being negotiated differently than those covenant-light documents?
So covenant light is a phenomenon that attaches to over 80% of the issuances that we see. It allows these LMEs to happen. The creditors that are taking part in an LME are negotiating better covenants on the back end of that transaction. So I will exchange my debt, oftentimes at discounts in price, for new debt, and that new debt will have covenants attached to it that will protect my new instrument.
Tell me more about that covenant light and the connection to LMEs. Is it that the way the documents were written allowed for an LME to occur? Were there ever covenants that wouldn't provide for an LME type transaction?
So oftentimes when we say covenant-light debt, we're referring not only to the covenant itself, but the actual broader language of these credit agreements today that allows companies to take assets that are theoretically secured and move them away from the current creditors. So the LMEs are occurring because of the looseness of the documents as a whole. I like to say that 20 years ago, plus when I started my career, a secured creditor was first in line and he didn't have to really read the document. In fact, the secured creditor had all the assets. 10 years ago, that started to evolve. And today, sometimes we think the unsecured creditors are in a better position than the secured creditors because they can do LMEs and go attached to these secured assets that are really not protected by the indentures or credit agreements today.
That's interesting. In the Roundup piece, you did reference that LMEs can be a detriment to the unsuspecting existing lenders. And I think you might have just touched on why that is, but could you expound?
Sure. There's all sorts of instances of companies taking a brand, for example, or a single asset out of the package that the secured creditor is entitled to because the document allows it, and then offering that to other creditors in exchange either for maturity extension or for capturing debt discount. And so if I'm buying a credit today with a 50-cent price and I'm not aware that that collateral package I thought I was entitled to is not protected, I could see myself lose those assets to other creditors that step in with new money or step in to offer debt discount to the company and roll their old debt into a new instrument that's secured, in fact, by the collateral I thought I had.
So, Steve, how do liability management exercises fit into the default picture today?
The average default rate going back over time is about 3% in high yield, leveraged loans and high yield. Today, we're only around 1.5% default rate. So optically low versus history and averages. But if you include distressed exchanges in that number, we approximate today about 4.25% default. So we're actually above normal, which is what you might expect in a high interest rate environment. So we are seeing companies today utilize distressed exchange much more frequently than in past times. Just some data on that. Year to date, 2024, we're about 35 billion of distressed exchange volume, which is the equivalent to what we had in 2008 during the GFC. We're on pace this year for about 50 billion, which would be an all-time high, I believe. And that would again make up about 2/3 of all the default volume on the year. Also very elevated levels relative to history.
Gosh, it's pretty substantial, and I don't think it's discussed all that much in the regular financial media. Now, let's talk about how an investor can make sure he's on the right side of a liability management exercise.
I would say our mode today is, one, sometimes we pass on investments where we think we can't be on the right side of that equation. Two, entry price matters, so protecting yourself with downside on entry. But leaving those two aside, I would say that the game plan is multi-step. First, it's just good old-fashioned due diligence. We really need to understand these businesses, understand asset value and cash flows, because those are going to be the seed, ultimately, of what happens with the capital structure. Second, we need to really understand the docs. Again, 25 years ago, I think reading the doc was less important. It's become much more material to our diligence today. And so an understanding of documents becomes a core to what we do. Third, might makes right. I think size matters within a capital structure. So if you're going to be in a capital structure as a tourist and a small player, you better be willing to trade in and out of that because you're not going to be able to protect your position the same way if you were large. Fourth, relationships. Making sure that you have the relationships both with the advisors and the competitor firms such that you can partake and participate with them in these capital structures rather than finding yourself outside the room. Last note, just on co-ops, there's been a major rise in the use of these co-op agreements and oftentimes very successful. We've seen cases where over 80% of the creditors have joined a co-op in a defensive maneuver to protect against the company. We've also seen them used offensively where 51% of the creditors will get together and leave the other 49% outside the room. And so making sure you understand the dynamics around those co-ops as you're building a position or thinking about building a position, all important. Maybe to sum that all up, these are all table stakes. If you do any one of these components wrong, you're at risk. And again, that's why sometimes the answer is you stay out of the room and you wait for the next investment.
And I guess you could also say you shouldn't try this at home.
That's true. Again, the relationship piece is huge. We've had to negotiate our way into creditor groups, relying on years of relationships to ensure that we protect our investors in these investments.
Finally, Steve, in the Roundup, you say that LMEs aren't going away anytime soon. So what's the outlook here? Would anything in particular suppress the phenomenon or alter the landscape?
I think the proliferation of LME is partly docs, as we've talked about, and it's partly that we have many more sponsor-owned companies. The sponsor has a lot to lose in a bankruptcy because they lose all their ownership of the company. Public company boards and management teams have a little bit of a different risk profile. Old management teams can get new equity in a restructured company, and boards see a lot of liability in LME. So we're seeing them happen more often in sponsor-based companies than we are in public companies. Although even that's changing because as LMEs become a common tool, boardrooms are getting more comfortable with it. We have a relatively healthy economy, so I think good and even mediocre businesses today have cash flow to support these restructured capital stacks. LME oftentimes comes with higher cost debt. And if you have enough cash flow to support that, you can do an LME. So like anything else, maybe it's the economy that's going to determine the outcomes here. As we see weaker cash flows, weaker economy, we'll see mediocre companies have less access to this tool. And we'll see an increased rise in Chapter 11. Maybe one just interesting aside, 1/3 of the LMEs happening this year are from previous LMEs. So we're seeing LMEs on LMEs. And I think, again, the relative strength of the economy and the easy access to capital with credit spreads at near all-time lows is allowing these to happen. As you see credit spreads widen, you see less access to capital, you see more Chapter 11s over LMEs into the future.
Well, it's been great speaking with you, Steve. Thanks so much for joining me.
Thanks for having me.
For our final conversation, we're going to zoom in on one specific area undergoing quite a bit of dislocation, and that's real estate. For this discussion, I'm very happy to be joined by Kenya Williams, Oaktree's senior real estate specialist. Kenya, thanks for joining me.
Thanks, Nicole. Nice to see you as well.
Kenya, to begin, can you discuss the general state of the real estate markets? Which segments are under stress and maybe which ones have shown greater resilience?
Sure. Today, I would say a mixed bag in terms of results in the market. The commercial real estate space has really been in a distress cycle since interest rates started rising in 2022. We've seen commercial real estate prices on average drop about 22% since they peaked in late 21, early 22. Just for the first time earlier this year, we saw a bounce back in terms of average CRE valuation. So some green shoots in this space. However, the data is very mixed if you bifurcate the asset classes. Commercial real estate in the traditional office is still about 37% down, but you're seeing positive movements in apartments, which are up 3%, industrial up almost 2%, even retail up 1 to 2%, depending on the sector. So we've seen some mixed results, but some positive indications in terms of commercial real estate valuations. The transaction market and the debt markets are still off, but CMBS has been a bright light this year. It's been transacting at a much higher level, and we're seeing refinances get done. We're seeing new big transactions come through the market. We're probably still about half of the volume from pre-rate increase, but that's a big improvement from the prior years. This rate cut that was announced last week, 50 basis point rate cut, is expected to really be a bit of a support and prop up the market. But we've got an election coming up, and we've still got discussions about whether or not we're going to go into a recession. We've got mixed jobs numbers. We've got unemployment up a little bit, and then small decreases. A really mixed bag in terms of the data set. So it's a real time to focus on the fundamentals.
That's very interesting. I guess you're saying commercial may be at its nadir. There are mixed signals, of course, as you mentioned. So amid a dislocated environment like the one that we're in, would you say there's a need to seek out more niche areas of the real estate market?
Absolutely. It really is a sector by sector, geography by geography opportunity set. So this is a time where expertise and experience are really going to drive returns. Looking through the noise, through the headlines into specific sectors, looking at demographic shifts in the market, looking at the future state of where our economy is going is the opportunity to really find that next attractive investment opportunity.
In the Roundup piece, our real estate PMs dive into what they, I think, quaintly call the demographic dividend. And of course, in this sense, they were referring to the investment opportunity that's created by an aging U.S. demographic in respect of medical use real estate specifically. Can you talk a little bit about our thesis in this medical use real estate arena?
Sure. What we've identified as an opportunity is the medical office building sector. To step back for a moment here, I've mentioned that the overall office sector is under a lot of duress, and it's for all the reasons of the post-COVID return to work dynamics coupled with higher interest rates, inflationary costs. All those things together have really hit the traditional office market very, very hard. However, if you look through the headline noise, you're going to go into a sector by sector discussion. And then you also couple that with directionally what's happening in our economy and in our country. We have an aging population. By 2050, the population of America age 65 and over is going to increase by about 50%. So about 1 in 4 Americans will be over 65. We know that medical needs, treatment for chronic diseases will increase because of the aging population. What we've identified is an opportunity to invest in medical office buildings, which are really the outpatient buildings of traditional hospitals. So you and I every day probably go to our dentist, our dermatologist, our specialty care provider in a building that looks like an office. But when you go into each of these offices, there are specialized uses, equipment, treatment rooms, MRI machines, X-ray machines. These very specialized use office buildings are in high demand, especially as they are located in proximity to major hospitals, but also an expanding class as more local treatment centers for chronic diseases like cancer treatment and things of that nature. So what we're seeing is an opportunity to invest in this asset class by acquiring existing properties, looking at the positive trends that are going to support this asset class over the long term.
It's really interesting. And I know in our Roundup piece, we refer to these as MOBs, and I think very interesting asset class or sub-asset class within real estate. In the piece, it talks a little bit about the limited supply of these MOBs in the U.S. What factors do you think have contributed to that limited supply?
The supply really has to do with the factors that have impacted real estate development overall. Construction activity for medical office buildings dropped off in the pandemic and just hasn't recovered, even though demand has really increased over that time period. If you think about 2020 supply chain issues, materials, goods, that really impacted the construction environment. And then you've got increased construction costs as inflation really set in. And you've had increased interest costs. So you have this 1, 2, 3 punch forward construction of specialty use office buildings. And what's affected the market overall has impacted medical office construction as well. We are just behind the very strong increase in demand for these buildings. In addition to the desire for these buildings because of an aging population, we also have the fact that it's significantly cheaper to operate outpatient centers versus hospitals. I believe the statistic is something around 58% cheaper to treat someone in an outpatient setting versus in an actual physical hospital. So the industry has looked at it and said, oh, this is a better way to operate. Then you have the constraints of a interest rate increase that has really held back the market. So what you've seen is absorption has outpaced construction every quarter since the second half of 2021. And it's driven occupancy from 91.4%, which is already pretty high, to 93% at the end of 2023. We've also seen rental growth increase as well. So we're really seeing outsized demand and a product that's trying to keep up and catch up to where it needs to be.
Well, I know we love to find situations where there's that supply-demand imbalance. So this certainly seems like one. How are we prosecuting the opportunity? Is it a new development play? Are we taking existing properties that aren't built for medical use and retrofitting them? What's generally the approach here? And how high are the barriers to entry, Kenya?
We've got a two-phased approach currently in the strategies that we're investing in medical office buildings. So the first opportunity set that we tapped into was large publicly traded REITs that specialize in medical office buildings that have been trading at a discount to NAV just because the markets have not valued that REIT space appropriately. As a result, these REITs have needed to delever and find liquidity solutions. And so we've been able to acquire attractive office buildings from these REITs at a really attractive basis and owning existing space with an opportunity to value add in those spaces. So retrofit, renovate lobbies, and create more space and more attractive space to attract the next generation of outpatient medical users. The first step was acquiring portfolios of existing office buildings. And then the next phase that we're looking at is the construction and development side, where we're going to do ground up construction near hospitals of medical office buildings to continue to meet the demand that's underserved today. The barriers to entry are just who's got the money to actually develop these projects today. It's really attractive because medical office tenants have high build-out costs. So you're talking about an average of $350 a square foot for a tenant improvement build-out for these spaces. So the tenants are incredibly sticky. Once they're in, they're long-term users. And then there's just overall the industry demand pushing more of the treatment of patients to the outpatient basis.
Very interesting. How do you think healthcare reform might expand or detract from the opportunity?
The thing that's talked about in this country constantly is just the cost of healthcare, just the overall cost. On every front, whether it's Medicare or it's private insurers, there's a desire to find the most efficient way to meet the medical demand that's being driven by the population base. I think you're going to see as the population ages, there's going to be more demand, and the government or health insurers are going to have to respond to that the most efficient way possible. So I do think it's a positive in that they're going to look to push more and more costs out of major hospitals into outpatient centers. They'll be doing more complex treatments at outpatient centers. So I think that overall, it'll be a positive development for the sector. It's geographic as well. So if you think about the out-migration that's happened from major cities into Sunbelts or higher growth secondary markets, the supplies have to be adjusted in those markets too, even on a state-by-state basis. So it's going to be imperative to control costs as the medical needs expand, and this is a great way to do it.
Kenya, do you have any final thoughts on the current opportunity in medical use real estate, or maybe in how secular demographic trends are creating investment opportunities in real estate more broadly?
Yeah, I believe that medical office buildings are an excellent way to address the aging demographic in the U.S. and also just the need for the U.S. healthcare industry to think about reducing costs and becoming more efficient. It's estimated that 230 million Americans, or nearly 70% of the total population, could be living with a chronic disease by 2030, which is a daunting thing to hear, but it really does speak to the overall need and demand of the sector. And I also believe that the medical office sector today is really focused on being near or on campus, meaning proximity to hospitals. But I think as this sector evolves, you may see additional centers moving more to neighborhoods, really catering to a local demographic or a local need. Maybe it's a localized cancer treatment center, so that these people who are going for treatment aren't going to major hospitals. We're going to a much more comfortable, relaxed environment for their treatment. So as always, the sector will respond to the population and what's happening in healthcare overall. But I do believe that this is a really attractive opportunity set because it's just starting to evolve and will be pushed to evolve quickly as our population ages. Then in terms of other secular demographic trends, I think real estate always follows what's happening and how people live and experience life. The boom in what's happened in the industrial sector has been a direct result of online shopping and the need for retail to come into your home. And then also you see things like the growth in AI has really driven up demand for data centers. So you're always seeing the real estate industry respond to opportunities that are coming real time in the markets today. So that'll continue to happen. And I think the future is bright.
Thanks so much, Kenya.
Thanks, Nicole.
Notes and disclaimers. This recording and the information contained herein are for educational and informational purposes only and do not constitute and should not be construed as an offer to sell or a solicitation of an offer to buy any securities or related financial instruments. Responses to any inquiry that may involve the rendering of personalized investment advice or affecting or attempting to affect transactions in securities will not be made absent compliance with applicable laws or regulations, including broker-dealer, investment advisor, or applicable agent or representative registration requirements, or applicable exemptions or exclusions therefrom. This recording, including the information contained herein, may not be copied, reproduced, republished, posted, transmitted, distributed, disseminated, or disclosed in whole or in part to any other person in any way without the prior written consent of Oaktree Capital Management LP, together with its affiliates, Oaktree. By accepting this document, you agree that you will comply with these restrictions and acknowledge that your compliance is a material inducement to Oaktree providing this document to you. This recording contains information and views as of the date indicated, and such information and views are subject to change without notice. Oaktree has no duty or obligation to update the information contained herein. Further, Oaktree makes no representation, and it should not be assumed, that past investment performance is an indication of future results. Moreover, wherever there is the potential for profit, there is also the possibility of loss. Certain information contained herein concerning economic trends and performance is based on or derived from information provided by independent third-party sources. Oaktree believes that such information is accurate and that the sources from which it has been obtained are reliable. However, it cannot guarantee the accuracy of such information and has not independently verified the accuracy or completeness of such information or the assumptions on which such information is based. Moreover, independent third-party sources cited in these materials are not making any representations or warranties regarding any information attributed to them and shall have no liability in connection with the use of such information in these materials. Copyright 2024, Oaktree Capital Management LP.
Audiation.